When the news shows missiles flying over desert skies, when oil tankers reroute through distant waters, when diplomatic channels go quiet, most Americans watching from their living rooms think, what a tragedy. But what does any of this have to do with me? That question deserves to be taken seriously because the answer lands much closer to home than most people realize. It reaches your gas pump within weeks. It shows up in your grocery bill within months. It extends the timeline on refinancing your mortgage. It keeps borrowing costs elevated longer than you planned. And it puts quiet, persistent pressure on retirement portfolios that were positioned for a more accommodating environment, not because of politics, because of mechanism, because conflicts in that region have a well documented pattern of flowing through the global energy system into the inflation data that Washington monitors and into the deliberations of the Federal Reserve, where the decision about when to ease interest rates is made. When that data moves in the wrong direction, the rate reductions that markets have been pricing in and that households have been planning around get postponed. Understanding why, tracing the logic step by step is not just intellectually useful. For anyone managing a mortgage, a retirement portfolio, or a fixed income in this environment, it is a practical necessity. So let us trace this from the beginning. Before we talk about the Middle East, we need to understand the machine. Think of the global economy as a vast interconnected engine. It runs on labor, credit, consumption, and production. But one of its most foundational fuels embedded in nearly everything is energy. And one of the most powerful regulators of how smoothly that engine runs is the price of that energy. When energy is cheap and abundant, the costs of producing and moving goods fall across the board. Businesses expand, consumers retain more purchasing power after covering essentials, the engine runs with less friction. When energy becomes expensive or uncertain, those dynamics reverse, transportation costs rise, manufacturing costs rise. Agriculture becomes more expensive because modern farming is deeply energy dependent, from the natural gas and fertilizers to the diesel and heavy equipment. When costs rise across so many sectors simultaneously, the pressure on prices is broad, persistent, and difficult to contain. This is not a theory. It is a structural feature of how modern economies are built, and it is precisely why conflicts in the Middle East, a region that sits atop a substantial portion of the world's recoverable oil reserves and controls some of its most critical shipping lanes, do not stay in the Middle East. They travel. They travel through commodity markets, into inflation readings, into the calculations of central bankers, and ultimately into the financial conditions that determine what you pay to borrow money, what your savings can sustain, and how reliable the plans you have built actually are. That chain of transmission has appeared repeatedly across decades, across different administrations, across different conflicts and different economies. The specific details change. The mechanism does not. That is what we need to understand. Let me explain what the Federal Reserve actually does in plain terms. The Federal Reserve functions as a thermostat for the broader economy. When the economy runs too hot, when spending accelerates beyond the economy's productive capacity, when inflation erodes the purchasing power of money at a pace that disrupts planning, the Fed tightens. It raises interest rates. Borrowing becomes more expensive. Credit growth slows. The pace of spending moderates. When the economy runs too cold, when unemployment rises, when credit contracts sharply, when businesses stop investing, the Fed eases. It lowers interest rates. Credit becomes cheaper, activity picks back up, simple in concept, extraordinarily difficult in practice, because the Fed is not managing a closed system. It is managing a thermostat in a room whose windows open onto the rest of the world. External forces, supply shocks, geopolitical disruptions, Currency crises blow through those windows and make the thermostat's job dramatically more complex. And here is where we are in the current cycle. After a rapid and aggressive rate hiking campaign designed to bring inflation down from multi-decade highs, the Federal Reserve made meaningful progress. As inflation moderated from its peak, market expectations naturally began to shift. Financial markets anticipating that the next policy move would be downward, increasingly priced in the possibility of easing. Interest rate futures moved, bond markets responded, equity valuations adjusted. But the Fed itself told a more cautious story. Officials were explicit. Rate reductions would require sustained and convincing evidence that inflation was returning durably to target, not simply moving in the right direction for a quarter or two. Markets and the Federal Reserve were not always reading the same page. Markets were pricing in probability. The Fed was waiting for proof. Then the Middle East changed the data environment, not by issuing an instruction to the Fed, but by injecting new uncertainty into the commodity markets that feed the inflation readings the Fed weighs most carefully. When those readings stall or move in the wrong direction, a central bank that was already cautious, already insisting that the data lead has strong and consistent reason to wait longer, that waiting has consequences that extend well beyond the Fed's meeting rooms. The year is 1973. In response to U.S. support for Israel during the Yom Kippur War, Arab member nations of OPEC impose an oil embargo. Over the following months, the price of crude oil surges several fold, one of the most abrupt commodity shocks in modern economic history. What follows is instructive, not as a story, but as a mechanism. Inflation surges across the United States, not because the government printed too much money, not because consumer demand ran too hot, but because oil is woven into the cost structure of nearly everything: plastics, heating, transportation, manufacturing. The price shock does not stay in the energy sector. It disperses. The Federal Reserve of that era wavered between fighting inflation and protecting growth. Inflation became embedded in expectations. Workers demanded higher wages to offset higher prices. Businesses raised prices preemptively. A temporary supply shock became a structural inflation problem, one that required the severe medicine of Volcker-era double-digit interest rates and a deep recession to finally break. The core lesson, the one the Fed of today has internalized, is not that oil shocks always produce catastrophic outcomes. It is that a central bank that underestimates how persistent a supply-driven shock can be and how quickly it can work into wage expectations and pricing behavior pays a severe and delayed price for that underestimation. That is why when external energy pressures reappear, the Fed's instinct is to hold rather than ease, even when the source of the inflation is a supply disruption that monetary policy cannot directly fix. The credibility cost of being seen to tolerate inflation is something the institution treats as existential, and that calculus shapes everything that follows. Now, let us be precise about how Middle East instability translates into economic consequences. We are not talking about vague geopolitical unease. We are talking about specific, well-understood channels through which conflict becomes variable in the cost of living. The first channel is the critical choke points. Roughly 20% of the world's seaborne oil supply passes through the Strait of Hormuz, the narrow waterway between Iran and Oman. A significant share of global shipping, including energy cargoes, also transits the Red Sea corridor. When conflict threatens these routes through naval confrontations, attacks on vessels, or the credible threat of either the market does not wait for actual disruption to reprice, insurance premiums on tankers rise, shipping operators reroute, adding time and cost. The uncertainty itself becomes a premium layered on top of the base price of crude. The second channel is the production decisions of OPEC's leading producers. Saudi Arabia, OPEC's largest and most influential crude producer, has both the capacity and the incentive to adjust production in ways that can amplify or dampen price movements during periods of regional stress. When instability rises and higher prices align with the kingdom's fiscal requirements or strategic positioning, the production decisions made in Riyadh carry significant weight in the global oil balance. The direction of those decisions toward restraint or toward expansion can materially shift where prices settle during a period of market uncertainty. The third channel is the geopolitical risk premium, perhaps the least visible but most immediate of all. Oil futures markets respond not just to physical supply and demand, but to the probability of disruption. When conflict escalates, traders reprice that probability. A geopolitical risk premium is added to the forward price of crude, and it can persist for months, regardless of whether actual supply is affected. During that period, inflation data reflects elevated energy prices that have no straightforward monetary policy solution because the cause is geopolitical rather than monetary. And here is the critical distinction that matters most. Middle East instability does not by itself determine Federal Reserve policy. The transmission is conditional. It depends on how significantly oil prices move, on how long the elevation persists, on whether rising headline inflation begins to feed through into core measures, the ones that strip out food and energy and track the deeper underlying trend. And crucially, on whether inflation expectations among consumers and businesses begin to drift upward, because once expectations shift, behavior follows, and the inflation becomes more self-reinforcing. What the Middle East crisis does is inject uncertainty into all of those variables simultaneously. It makes the Fed's data harder to read clearly. And a Fed that was already data dependent and deliberate, one that was already requiring sustained evidence before acting, becomes more cautious, not less, when the signal is harder to read. That caution produces a delayed timeline for rate reductions. And that delay, compounded across months, reaches into the financial life of ordinary households in ways that are quiet but cumulative. Let me offer some principles, not predictions, not certainties, frameworks for reasoning through complex, uncertain situations with analytical clarity rather than reactive emotion. The first principle: if you understand incentives, you understand behavior. Every actor in this situation, the Federal Reserve, OPEC producers, geopolitical powers, oil market participants, is responding to a specific set of incentives. The Fed is incentivized, above all, to protect its credibility on inflation. Easing prematurely and watching price pressures reaccelerate would be far more damaging to its standing than holding rates higher for longer than strictly necessary. The asymmetry of that risk shapes every decision. OPEC's leading producers are incentivized to balance domestic fiscal needs against the risk of demand destruction and the management of relationships with major consuming nations. Oil market participants are incentivized to price in probability distributions, not certainties. They hedge against scenarios, which means they move prices before events actually occur. Once you understand these incentive structures, behavior becomes less surprising and more legible. You stop asking why would they do that and start asking, given their constraints and objectives, what are they most likely to do next? The second principle: conditional reasoning is more durable than point forecasts. No one can tell you with confidence how long the Middle East situation will last, how far oil prices will move, or precisely when the Fed will begin easing. But the conditional logic: if prices stay elevated for this duration, then core inflation is likely to respond in this way. If core inflation stalls, then the Fed's posture is likely to shift in this direction is far more knowable than specific outcomes. Building your thinking around conditional reasoning gives you a framework that adapts as the situation evolves, rather than a forecast that becomes obsolete the moment a single variable changes. This is the discipline of navigating uncertainty rather than trying to eliminate it. The third principle: stress test the assumptions your plan is carrying. One of the most productive and most frequently neglected habits in financial planning is asking, what does my current plan require to be true? Most plans, explicitly or implicitly, carry assumptions about interest rates, inflation, and asset trajectories. Those assumptions are not wrong. To hold planning requires assumptions, but they need to be examined under pressure. A plan that requires rates to fall within a specific window is a plan with a single path dependency. Stress testing means identifying the alternatives to that path before you need them, not in the middle of a market dislocation when the pressure to act impulsively is highest and the quality of decisions is typically lowest. The fourth principle: avoid one way bets. The most dangerous financial position in an uncertain environment is one that performs well only if one specific scenario unfolds. Borrowing heavily against the assumption that rates will fall quickly, a one way bet. Concentrating a portfolio in long duration assets on the expectation of rapid disinflation is a one way bet. Timing major financial decisions around a single anticipated Fed meeting is a one way bet. One way bets are not inherently wrong when the environment is calm and predictable. They become dangerous when external shocks introduce scenarios the position cannot accommodate. The antidote is robust positioning across multiple plausible outcomes, not optimal in one, but resilient across several. Let us trace the full chain reaction carefully, step by step. The first step: the conflict escalates. Whether it is a naval confrontation in the Red Sea, a strike on energy infrastructure, a deepening proxy conflict, or a credible threat to shipping routes, the specific trigger matters less than the market effect it produces, a perceived increase in the probability of supply disruption. The second step: oil prices move. Within hours or days of a significant escalation, crude benchmarks rise. Traders reprice the risk premium. Insurance costs for tankers spike. The forward price of oil incorporates a new expectation of tighter supply or higher risk. The third step: energy costs, work through the economy. With a lag of weeks to months, elevated oil prices spread through the cost structure. Gasoline prices rise at the pump. Diesel, which powers the trucks, trains, and ships that move goods, becomes more expensive. Airlines raise fares. Freight costs rise. Agriculture, deeply dependent on energy inputs, becomes more costly to operate. The fourth step: consumer prices respond. Headline inflation, which includes food and energy, moves upward. Initially, the Fed may look through this, reasoning that energy driven spikes tend to be temporary. But if the elevation persists, if oil prices remain high for 3 months, 6 months, longer, a subtler process begins. Workers facing higher costs at the pump and the grocery store factor those costs into wage negotiations. Businesses facing higher input and transportation costs build them into their pricing. This is the second round effect, the point at which a supply shock transitions from an energy problem into a structural inflation problem. It is what central bankers lose sleep over, because it is where a temporary shock can become a persistent one. The fifth step: the Fed becomes more cautious. At each meeting, the Federal Open Market Committee reviews the accumulated data. If inflation is falling convincingly and sustainably, the case for easing strengthens. If inflation is stalling, or if headline pressures risk feeding into core measures, the case weakens materially. An oil shock with uncertain duration makes the data harder to read clearly. It introduces noise into the signal. A Fed that was already data dependent and deliberate does not ease into ambiguous data. It waits. The sixth step, the delay reaches your household. The variable rate debt you carry, a mortgage, a home equity line, a business credit line, stays more expensive longer than your plan assumed. The refinancing window you were watching, the rate threshold at which refinancing becomes economically meaningful, stays closed. The bond portfolio in your retirement account does not recover as quickly as projected. The monthly budget you balanced around an anticipated easing of borrowing costs remains under pressure. None of this requires a dramatic escalation or a financial crisis. These are the quiet, cumulative consequences of a timeline that shifts by 6 months, or 9 months, or a year. Quiet consequences are still real consequences. Consider a man named Robert. Robert is 64 years old. He spent 35 years in manufacturing, saved carefully, and retired recently. His plan rested on a few assumptions, reasonable ones at the time he made them. He assumed that borrowing costs would ease within a year, allowing him to refinance his remaining mortgage at a meaningfully lower rate. He assumed that his basic expenses, groceries, utilities, transportation would stabilize as the inflationary surge faded. He assumed his retirement portfolio would benefit as financial conditions gradually eased. Then the Middle East situation escalated. Robert did not follow the oil markets. He watched the news, worried for those caught in the conflict, and returned to his life. But over the following months, things did not move as expected. His grocery and utility bills stayed elevated. When he called about refinancing, the rates had not moved as anticipated. His portfolio fluctuated as markets adjusted to a longer wait for easing. Nothing catastrophic. A steady divergence between what the plan assumed and what reality delivered. Robert did not plan poorly. He planned carefully, under assumptions that were reasonable when he made them. What he experienced was the consequence of a plan built around a single expected path and an external shock that shifted that path. The lesson is not that the conflict was predictable. It was not. The lesson is that any plan worth building should be tested against the possibility that the expected path arrives later than projected and should carry meaningful alternatives for when it does. 3 episodes in history illuminate how geopolitical energy shocks interact with monetary policy, and they are worth comparing, not simply recounting. The first episode is 1973, The Persistence Problem. The 1973 oil embargo produced the foundational failure mode, a central bank that underestimated how long a supply-driven shock would last and how deeply it would embed into wages, pricing behavior, and expectations. The shock was initially treated as temporary. It was not, and the delayed, insufficient policy response allowed inflation to become self-reinforcing, requiring a prolonged and painful correction a decade later. The lesson: duration matters more than magnitude. A shock that persists long enough rewires behavior. The second episode is 1990 to 1991, The Duration Advantage. Iraq's invasion of Kuwait produced an immediate doubling of oil prices and pushed the U.S. economy into recession. The stagflation dilemma was real: rising prices, slowing growth, no clean policy response available, but the conflict resolved faster than feared. Oil prices normalized before second-round effects fully took hold. The Fed held its course, the recession proved brief, and the damage to expectations was limited. The lesson: when a shock is sharp but short, the mechanism does not complete its full transmission. Duration is the variable that separates a manageable episode from a structural problem. The third episode is the present, a different starting position, the same mechanism. The United States is now a substantially larger domestic energy producer than it was in either of those earlier periods. That provides meaningful insulation, but not immunity. Oil is priced globally. A disruption in one part of the system affects prices across the system. What is genuinely different today is that the Fed is operating with an institutional memory of 1973 and with a credibility it cannot afford to compromise. That makes it more cautious, more deliberate, and more likely to delay easing than to ease prematurely, even if the cause of elevated inflation is a supply shock it cannot directly address. Three periods. Three configurations of magnitude, duration, and policy response. The mechanism that connects them is identical. What changes is how far along that mechanism the disruption travels before it resolves. That is the variable no one can predict with certainty. And it is precisely why positioning for multiple durations rather than betting on a specific resolution timeline is the structurally sound approach. Let me give you a more precise picture of how the Fed processes this environment. The Fed does not respond to news events or market narratives. It responds to accumulated data and to what that data implies about the probability distribution of inflation over the medium term. That distinction matters because it means the Fed and financial markets are often running on different clocks. Markets reprice rate expectations within hours of new information. The Fed updates its assessment across months of data in increments through a deliberate institutional process. The indicators that carry the most weight in that process are the following. The first is headline CPI and PCE, the broadest inflation measures covering food and energy. These are the first to move when an oil shock hits, and they are what households actually feel. The Fed monitors them closely even when its public emphasis is on core measures. The second is core PCE, the Fed's preferred measure of underlying inflation trend, stripping out food and energy precisely because those categories can be volatile for non-monetary reasons. A supply shock that stays confined to headline numbers is manageable. One that works its way into core through freight costs, service prices, and wage expectations is a categorically different problem, one that monetary policy is less well equipped to resolve quickly. The third is inflation expectations, what consumers and businesses expect prices to do going forward. This is arguably the most consequential indicator of all, because expectations shape behavior. When people expect prices to keep rising, they ask for higher wages and accept higher prices. Those actions make the expectation self-fulfilling. The Fed monitors these surveys with particular vigilance, and any sustained upward drift in expectations tends to harden its resolve against premature easing. The fourth is labor market data, specifically wage growth. Wages rising well above the pace consistent with 2% inflation signal that higher prices are becoming embedded in the income structure rather than remaining a surface level phenomenon. Here is the institutional reality that ties all of this together. In principle, the Fed should be able to distinguish between demand-driven inflation, which monetary policy is designed to address, and supply-driven inflation, which it cannot fix by moving rates. Raising interest rates does not produce more oil. It cannot reopen a blocked shipping lane. In a narrow technical sense, the correct response to a pure supply shock might be to hold rates steady and let the shock pass. In practice, the Fed operates under a credibility constraint that modifies that calculus. A central bank seen to be easing while headline inflation remains elevated risks the very thing it has most reason to fear, an unmooring of inflation expectations. Once expectations drift, the real policy work becomes substantially harder and more costly. So even when everyone in the room understands that the source of the problem is geopolitical rather than monetary, the Fed finds itself constrained to delay, not because delay solves the supply problem, but because the alternative, being perceived as having blinked on inflation, carries consequences that outlast the original shock by years. That is the credibility trap. And it is the precise mechanism through which a conflict thousands of miles away extends the timeline on your borrowing costs at home. Let us move from the analytical to the concrete. For anyone who was watching the refinancing window, refinancing only makes financial sense when the gap between your current rate and the available market rate is wide enough to justify the closing costs, the paperwork, and the disruption. That gap requires rates to fall to a specific threshold, and the timeline for reaching that threshold extends directly with each month the Fed delays easing. The practical discipline: build your plan around your current rate as the working baseline. If a refinancing opportunity emerges, treat it as an improvement on the plan, not as a requirement for the plan to remain viable. Any plan that requires a favorable refinancing to remain solvent is a plan with a structural fragility that should be addressed now, not after the window fails to open. For anyone carrying variable rate debt, home equity lines of credit, adjustable rate mortgages, and business lines of credit are directly exposed to the prevailing rate environment. A 6 to 12-month extension of elevated rates, which sounds abstract as a policy matter, can translate into thousands of additional dollars in annual debt service for a typical household. Real money that does not go towards savings, investment, or building the buffer that creates financial resilience. The practical discipline: model what a 12-month extension of current rates means for your monthly obligations. If the answer is manageable, hold the plan. If it is not, address it before the pressure becomes acute. Restructuring from a position of stability is always less costly than restructuring under duress. For anyone holding bonds or fixed income, bond prices move inversely with interest rates. Extended elevated rates mean extended suppression of longer duration bond prices, a direct source of paper losses for many retirement portfolios. But there is a second order consideration that matters equally. If you are buying bonds or CDs in this environment, you are locking in yields that are historically favorable relative to the low rate decade that preceded the hiking cycle. Shorter duration instruments let you capture those yields while preserving the flexibility to reinvest as conditions change. The critical distinction: the market price of your existing bond holdings and the income those holdings generate are two different things. Market prices fluctuate with rate expectations. Income for fixed rate instruments does not. If you are in the distribution phase, drawing on your portfolio to fund living expenses, understanding this distinction determines whether an elevated rate environment is a net problem for you or a partial benefit. For anyone retired and living on a fixed income base, this is where the stakes are most direct. A 6 to 12-month delay in easing means that a retiree drawing down a fixed portfolio does so at higher withdrawal rates than projected, drawing down more principal earlier in the sequence than the plan assumed. For retirement math, sequence matters enormously. Early drawdowns compound against you in ways that later recoveries cannot fully reverse. Ensuring some portion of your portfolio is allocated to instruments that adjust with inflation: Treasury inflation protected securities, real assets. Assets with pricing power provide structural insulation that fixed income alone cannot. And on the difference between market repricing and household reality, when equity markets decline because rate cut expectations are pushed back, that repricing happens immediately, often within hours. Your retirement account statement reflects it by the end of the month. But household reality moves far more slowly. Changes in interest rates take 12 to 18 months to transmit through the real economy. A market correction driven by delayed rate cut expectations is not necessarily a signal that your household situation has deteriorated. It may be a signal that markets are adjusting their timeline, a timing shift, not a structural collapse. Making dramatic financial decisions in response to market repricing without first determining whether the underlying household reality has actually changed is one of the most common and most costly errors in personal finance. The market's clock and your household's clock are not synchronized. Recognizing that asymmetry protects you from reacting to noise as if it were signal. Let me offer you something more durable than a commentary on the current moment. The Middle East situation will evolve. Rate expectations will shift. The specific variables we have been discussing will change. What should not change, what cannot change if you intend to navigate an uncertain world effectively over decades, is the quality of the framework you use to make decisions. The first structural guideline is to position for multiple scenarios, not one. The goal of sound financial positioning is not to be perfectly calibrated for the most likely outcome. It is to be robustly positioned across a range of plausible outcomes to perform acceptably in the difficult scenarios so that you remain able to benefit from the favorable ones. A portfolio that holds cash, bonds of varying durations, equities across sectors and geographies, and some real asset exposure is not optimized for any single environment. It is designed to hold up across several. During inflationary periods, real assets and commodity exposed equities may lead. During slowdowns, quality fixed income and cash preserve capital. During recoveries, equities appreciate. No single component wins in every environment. That is not the goal. The goal is that no single scenario destroys the structure. The second guideline is to stress test the plan you have. Take your current financial plan and ask the load-bearing questions. What does this plan require to be true about interest rates, about inflation, about my liquidity needs over the next 12 to 24 months? What happens if rates stay elevated for another year? What happens if inflation reaccelerates modestly? What happens if an unexpected expense emerges at exactly the moment when asset prices are suppressed? These are not comfortable questions. They are meant to reveal the single path dependencies in your plan, the assumptions that, if they fail, put the rest of the structure at risk. Identifying them now, while you have the stability to think clearly, is the entire point of the exercise. The third guideline is to maintain liquidity as strategic optionality. In periods of genuine uncertainty, cash is not a failure of strategy, it is a form of optionality. Liquidity means you can meet your obligations without being forced to sell assets at inopportune times. It means you can take advantage of dislocations when others are compelled to sell. It means you make decisions from a position of strength rather than desperation. Holding 12 to 24 months of living expenses in liquid, low-risk form is a structural advantage, one that changes the character of every other financial decision you make. The investor who is not under pressure to liquidate will, across market cycles, outperform an investor of equal ability who is. The fourth guideline is to avoid the illusion of precision. One of the most seductive errors in financial planning is the belief that superior prediction is the key to superior outcomes, that if you just forecast the Fed's timing correctly, position for the right oil price trajectory, or nail the earnings cycle, everything resolves in your favor. The evidence across long periods of time points in a different direction. The value of a financial framework comes not from its precision, but from its robustness. A plan built to remain viable across a wide range of outcomes will, over time, outperform a precisely calibrated plan that breaks when a single assumption fails. Precision is appropriate when the system is stable and knowable. Geopolitical conflict interacting with central bank policy during a supply shock is among the least stable, least knowable environments imaginable. In that environment, robustness is not a consolation prize for failing to predict correctly. It is the intelligent design choice. Let us step back one final time. The period from roughly 1990 to 2020 was, by historical standards, unusually stable. Globalization expanded, supply chains became deeply integrated across borders. The flow of goods, capital, and energy was largely uninterrupted. Inflation stayed low. Central banks could maintain accommodative policies for extended periods without serious consequences. That era is being replaced by something structurally more complex. Supply chains are being re-regionalized. Geopolitical alignments are reshaping trade relationships. Energy systems are in a decades-long transition that creates real costs even as it moves toward greater long-run stability. And the world's major powers are increasingly competing on the rules of the global economic system rather than coordinating within them. Each of these transitions introduces friction. And friction, in economic terms, means higher baseline costs, more frequent supply disruptions, and a policy environment where central banks face harder trade offs more regularly. The Federal Reserve is not just navigating a specific Middle East conflict, it is navigating a more structurally demanding world, one in which external supply shocks may be a recurring feature rather than an occasional exception. For Americans planning their financial futures, this context carries a clear implication. The environment of persistently low rates, low inflation, and smoothly appreciated financial assets that characterize much of the recent past may not be the right baseline assumption for the decade ahead. This is not a forecast of catastrophe. It is an observation about structural change, the kind of change that rewards adjusting planning frameworks early before the environment forces the adjustment under pressure. The concepts that seemed almost decorative during a long bull market, diversification, inflation protection, liquidity, stress testing, are foundational concepts in a world of structural friction. The difference between treating them as decorative and treating them as foundational is the difference between a plan that bends and a plan that breaks. Let me close with something worth carrying beyond this video. Every period of instability has felt to those living through it like it might be the one that breaks the pattern. And yet the pattern persists not because the specifics are the same, but because the underlying structure of incentives, cause and effect, supply and demand, debt and credit, remains remarkably stable across time. The Middle East conflict of the present is different in its details from the conflicts of earlier decades. The economy is different. The Federal Reserve is different. But the mechanism, the way that external energy shocks flow through commodity markets, into inflation data, into the deliberations of central bankers, and ultimately into the financial conditions of ordinary households is recognizable, consistent, navigable. You do not need to predict the exact timing of rate cuts to make sound financial decisions. You do not need to know how long the Middle East situation will last to build a resilient plan. What you need is a clear model of how the system works, a genuine respect for uncertainty as a permanent feature of the environment, not a temporary disruption that resolves itself if you wait long enough, and a commitment to building financial structure that holds across multiple plausible futures rather than one calibrated for the most comfortable one. The people who come through periods of instability in the strongest position rarely the ones who predicted the most accurately. They are the ones who understood the forces at play, respected the risks those forces carried, stayed composed when others did not, and made their decisions from principles rather than from the emotion of the moment. That has been true in every cycle worth studying. It is true now. What changes is the specific shape of the disruption. What endures is the advantage of being prepared for several futures at once because no one is ever given the luxury of preparing for just one. Thank you for watching. If this gave you a clearer model of how global forces connect to your personal financial life, share it with someone who is navigating the same questions. Understanding the mechanism is not just education, it is preparation.